Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, relevance and policy impact. I'm Govindraj, Ethiraj. World stock markets, including in India, have turned negative as latest polls in America have shown presidential candidate Donald Trump inching up against Hillary Clinton, the other contender. Investors apparently see Clinton as a status quo candidate while they're worried about Trump because of his position on foreign policy, trade relations and immigrants. On Wednesday, the Sensex and Nifty were down over 1.15%, with the Sensex losing 349 points to close at 27,527. On Thursday, the Sensex was down another 96 points to end at 27,430, a 4-month low. Now, the question we are asking is, to what extent will this outcome of the US elections affect Indian markets in the short and long term? And will India's own policy moves, such as the final goods and service tax or GST rate announcement on Thursday, help restore some balance? To discuss this, I am joined by Ramesh, Damani, stockbroker, Bombay Stock Exchange, Sudip, Bandopadhyay, Chairman, Inditrade Capital, and Ajay, Bagga, Chairman, OPC Asset Solutions. Gentlemen, thank you all for joining me. Ajay, let me begin with you first. So, November 8th is obviously a big day, and we are all, the whole world is actually waiting, including the markets, which was not something that was expected earlier.
Yeah, absolutely. And, because of the recency effect, what happened on June 24th with Brexit, where the markets were blindsided, there's a lot of trepidation going into these markets. And if you see the directly impacted currencies, say like the Mexican peso is down 3%. The Mexican ETF listed on New York Stock Exchange, or $1 billion ETF, has lost about 120 million in the last 2 days. So there is a lot of fear in the market. And that is coming into our markets as well. Right.
Okay. Sudip, your sense, why are Indian markets reacting so much?
Well, I think Indian markets are really afraid. Global markets are afraid. They don't know. Donald Trump is an unknown quantity, if you really see. Whereas Clinton is presumed to be status quo. So I think there is going to be a lot of nervousness, a lot of fear of what happens if Mr. Trump comes, and that itself will pull the markets down, and that's exactly what is playing out over the last few days. I won't be surprised if this continues till middle of next week, before the election results are known. And I think predominantly is being driven by the global markets. Right. Because the global markets are afraid it's coming down, and there is a repercussion of that in India. FIIs are in no mood to buy. They are actually exiting, selling positions. So obviously a bit of uncertainty is creating all this.
Right. So Ramesh, so FIIs, many of them are based in America. So how would they react, or how are they seeing, in your understanding, this whole development or set of developments leading up to the elections?
Well, there is, as your previous guest said, a lot of trepidation going ahead because having been burned by Brexit, they don't want to be burned again, so they're being very cautious. One thing that's very important in US election is, of course, momentum. And I think in the last weeks, in the waning days of the campaign, Trump has the momentum. And as you know, it's not a popularity contest as much as a 50 state-by-state contest. So even if 1 or 2 states move against Clinton, we could have a huge upset in favor of Trump. What the worry part is that there's political uncertainty. Markets like nature abhor a vacuum. And whether Trump will support the trade deals, whether Trump will support immigration, whether Trump will support low interest rates. These are all questions that the market will debate and discuss. The good part, the good news, of course, is that Trump is a businessman. He knows how to be decisive and tackle, cut to the knot of the problem. So I think after knee-jerk reactions, the market will sit back and kind of evaluate the policies that he might introduce in a Trump White House. But the first get-go would market be volatile and a knee-jerk reaction down, particularly in emerging markets because they've been built on trade, and Mexico will start the route down maybe 10%, and that route will roll through Asia and Europe.
This could be a good thing for Asia?
I'm hard-pressed to think it's a good thing because the US not only has economic leadership of the world, but also moral leadership of the world. And a candidate like Trump, given the past, how he's degenerated women, Muslims, whatever, is not the ideal candidate to provide moral leadership to the world. So while he might be decisive, I think the world rests on a lot more principles of equality, opportunity, meritocracy, things that Trump might roll back. 50 years of US progress on these areas might be rolled back. So on balance, I would think that while Trump may provide some change to the status quo, Hillary is probably the safer candidate for global markets.
Right. So, Ajay, now let's look at it from the India vantage point. So, we've had a GST rate announcement. We have 4 clear rates. All of this was a little unexpected. Maybe the rates themselves and the structure is a little confusing to some. But the fact that we're seemingly moving forward on policy is a good thing, or is it not?
It is a very big positive for the markets, and if you see this morning, our markets have reacted favorably to that, despite the global overhang, what Ramesh Bhai and Sudip were mentioning. So overall, it's good in a very difficult, complex environment to have reached this kind of consensus in a federal system, in a messy democracy. Markets are looking at it very positively.
Right. So, Sudip, if you were to look at the flows, right, FII flows that we were expecting or predicting before the whole election thing became big, what was it looking like?
I think it was looking very, very positive. If you look at, Govind, globally, I think pretty much all the institutions, including the long-term players, and I think one must remember that the long-term players coming in is definitely a sign of vote of confidence in the macroeconomic factors. Forget the micro. Micros may be good individual company-wise, but when a pension fund is coming and investing, large pension funds, it's definitely a kind of vote of confidence on the economy, and that was happening. So I think I'm not saying that's going to change drastically, but of course there is an uncertainty. Of course there is a kind of they are also confused as to how things will pan out, and I think till the time this thing gets resolved, I don't think we're going to see big investments by FIIs. So I suppose by mid-November, once things settle down, we will be in a position to predict the flows, but till then it's going to be uncertain.
Right. So Ramesh, just for the benefit of our viewers who perhaps may not understand this complexity, to what extent are foreign institutional investors important, and what role do they play in the movements of markets today?
They're, of course, Govind, as you well know, very important. They own 25% of almost the free float in the Indian stock markets, perhaps even more over the last few years. They are almost the critical suppliers of capital in many areas where, in technology, in FMCG, through FDI, which is not available domestically. And their figure each day of whether they bought or sold impacts the opening of the market the next day. So whether it's the government's disinvestment program, whether it's the FDI provision, the foreigners have provided long needed capital at very stable rates to a country that has been for most of its life capital starved. So they are almost the most important player on the Large Street, and what they do is watched very, very closely.
Right, got it. So considering that FIRs are going to play a significant role, and US elections or developments like US elections is something that could affect us or our markets maybe in the short term, if not in the medium term, what could be the other counterbalancing forces, Ajay?
Balance forces are the India growth, the India macro, the overall attractiveness of India as an economy and as an investment destination. That's the biggest thing going for us. Having said that, last 1 month we have seen outflows accelerating, and the bigger reason there is the Fed rate hike. The whole interest rate cycle in the US is probably moving, and the big thing will be December 14th, Fed might hike rates. And that is leading to some emerging market outflows, in which India is also seeing some outflows. But overall, within the pack, India remains one of the most attractive markets.
Right. So, Sudip, we talked about portfolio flows, right? So, many of the things Trump is saying, for instance, on trade can affect India in other ways, the economy, for instance, or companies who are exporting to the US, IT, though there have been no specific noises on that count. Are you expecting, or are you apprehensive on any of those counts?
Well, there are a lot of apprehensions, Govind, very clearly. People are talking about IT getting impacted, pharma benefiting. But I'd like to point out one fact. Look, as Ajay mentioned, there is definitely going to be change in US Fed stance, irrespective of whosoever becomes president. And that's definitely going to have a short-term impact on Indian markets. But we have a belief that while the monetary policy may be slowly changed, there has to be fiscal stimulus because US economy needs to keep growing. And we believe that fiscal stimulus will come, irrespective of whether Hillary comes or Donald Trump comes. It may take few months, but it will come. And that will be good for Indian economy because there are a lot of development activity which is not happening in US today. If it starts happening, India will definitely benefit. Indian companies today are world-class companies in a lot of spheres. And they will definitely benefit. Yes, one sector may be under cloud for some time because of some change in policy stance. But overall, I don't see India losing out in a big way. Also, one weird fact, but if you notice the history of India-US relations, Republican president has always
been good for the market, except for Donald Trump.
Yes, I mean that's what we are assuming.
Or at least the anticipation.
Anticipation. But always Republican president has been good. So I'll keep my fingers crossed.
Okay, Ramesh, do you want to weigh in on that? Republican presidents have been good for Wall Street, but maybe not so sure this time around.
I'm sorry to puncture a balloon, but that's almost a myth. I mean, remember the great bull market in America in the 90s? Clinton was president. In fact, it outperformed the Reagan bull market. There is no historical evidence that there's huge difference between Republican and Democratic president. It more depends on, the Fed cycle that is going on. And, the America is a system of good checks and balances. So even if Trump wants to do a lot of crazy things, as he's tweeted and talked about almost incessantly, I think Congress and the House and the Senate act as a check and balance on what he's able to accomplish. So the US presidency is more of a moral bully pulpit rather than executive action that can take place. It's not like in Indian parliament where you have to vote according to party whip. You still have to convince your congressmen and senators. So even if he does get elected, I'm sure the worst of his feelings against trade, against protectionism, against scrapping some NATO alliances, against immigration will probably be checked. So while it would be a knee-jerk reaction down, I think longer term the robustness of the US economic framework will probably rise to the top.
So let me ask the flip question before we go for today. Ramesh, let me begin with you. What if Clinton were to get elected?
Well, I think if Clinton were to get elected, there would be status quo. There would be probably a relief rally in the market. And I would look at sectors which would benefit hugely from that. For example, she's promised to spend $500 billion on infrastructure. So that would be a sector that would, almost immediately rise based on Hillary Clinton coming to power. I think pharmaceuticals, which she's been against for price gouging, will probably see a sell-off. So that's a quick summary of Clinton rises, status quo, relief rally, and individual sectors will start rotating in and out.
Okay, Sudip, what's your sense if Clinton were to...
A relief rally, of course, because markets are really worried.
There will be a rally, yeah.
There will be a relief rally, there is absolutely no doubt about
Globally.
it. Globally, absolutely. And that, of course, the impact of that will come to India. Over the 3 to 6 months, things will stabilize. And I strongly believe the same thing which I was mentioning, there will be fiscal stimulus.
Okay.
The US economy needs to move into a different gear. The monetary stimulus will be replaced by a fiscal stimulus.
Right. Okay, Ajay, last word.
I think markets will say that there will be a Republican Congress and she will be better than Obama at building some consensus with Paul Ryan to have a fiscal stimulus and try to inject some growth into the economy. So she'll be viewed positively, but I see some stall happening on December 14th because Fed will get confidence boosted if Hillary is elected and they will raise rates.
Okay.
If Trump is elected, markets go down, Fed will use that as an excuse not to raise.
Right.
So
right.
either ways, there is going to be a stall by December.
Right, and next week, of course, is going to be a turning point for America, and as we've been talking about the world at large, and particularly the markets in specific. Thank you all for joining me. We need to go in for a break. Coming up on the other side, Standard & Poor's credit rating for India is unchanged, and the government is upset. We'll find out why. Stay with us. Welcome back to Policy Watch. In a somewhat unexpected move, rating agency Standard & Poor's said it was keeping its sovereign rating for India unchanged at the lowest investment grade, that's BBB- with a stable outlook. More importantly, it rolled out an upgrade till 2017 end, a move that has provoked criticism from the government. S&P has said that the ratings reflect India's sound external profile and improved monetary credibility, but also pointed out vulnerabilities stemming from the country's low per capita income and weak public finances. Economic Affairs Secretary Shaktikanta Das expressed his disappointment to newspersons, saying that S&P report says all the right things have been done by India, but still the rating agency has not upgraded India. Now, the larger question we are asking is, what are the challenges that India has to clearly overcome, and why is it that close to 8% economic growth is still not improving India's investment rate? To discuss this, I'm joined by Devendra, Nevgi, CEO of ZyFin Advisors, and Sujan, Hajra, Chief Economist at Anand, Rathi. Gentlemen, thank you both for joining me. Let me begin with you. So what's your sense? Why is it that rating agencies don't seem to be seeing things as positively as we would like them to?
So one thing, Govind, is that very clearly, like markets, rating agencies don't operate in a forward-looking basis. So they don't work on hope. That is one thing which is very important. They will wait for the event to happen and then take the action. Next point is, very clearly the two things which highlighted by the rating agencies and especially S&P was fiscal deficit and the per capita. So my two quick things on fiscal deficit is very clearly, we have some issues in terms of the larger revenue growth and the revenue is funded completely by tax and one-time this thing, and you also have interest coverage, which is 1/4 of the revenue. But the key thing here is that we are inching closer to a primary surplus, which probably could come in 2018 or so, which is very important. On the per capita also, my thought is my thought is that per capita since 1991 on a nominal basis, at least in dollars, has grown by 7%, which is higher than the population growth of 0.9 or 1%. So the accretion to per capita is still happening, and I think we probably could be the one of the fastest growing there. So some of these points are also extremely important. Another thing is that India is still not exposed to Indian government balance, central government balance.
Right, so you're saying the per capita is a strong factor in our favor, right?
No, I'm saying that.
You're saying that's not enough.
Yeah, the per capita may not be enough, but it is a reasonable factor that is playing.
So you're saying it should have been more than 7%?
Yeah, it is growing at 7%.
Yeah, so it should be
from
more
1990, 91. It could, and if you take the recent times, I'm sure it must have grown more than that. And the point also is the central balance sheet is much better shaped, because we don't have any government. The government doesn't issue any dollar bonds abroad. The government doesn't have any foreign holdings. Foreign holdings in government securities is less than 5% or 4%. So we are in a reasonably good shape. I think if reforms take place, growth takes off.
Right. So you're saying, but the key thing is that the event has to happen for a rating agency to respond. But however, the rating agency is saying, Sujan, that we will wait till 2017 end before we say anything. Right. So in some ways, they've even ruled out an event or a response in the near future. So what's your understanding of that?
See, every time any rating agency comes out, even with upgrades, we always feel we are 1 or 2 notches, if
below
not
what we should be.
Lower than that. But objectively, if you look at India in the same credit rating group, India is the country with the lowest per capita income. India is the country with one of the highest fiscal deficit. So in that sense, if you see, credit rating ultimately is the default risk. Obviously, by definition, since government of India doesn't have foreign exchange debt, the chances of default is 0, because theoretically you can print money and repay it. But objective, and it's a surrogate, so it's a surrogate rating. So credit agencies obviously gives disproportionate weightage to the fiscal situation, and everything said and done, fiscal situation in India has not improved as much as we ourselves promised under the original FRBM. So having said that, I'm not too surprised. For the 2-year time frame, I think this is slightly absurd, because you don't know what's going to happen in 2 years. Not only upgrade, there could be possible downgrade also if there is something. So I think giving a 2-year forward-looking statement is slightly out of place.
Okay. Right. Now, so Moody's also said that they were unlikely to upgrade India's rating, and they had assigned the lowest investment grade, that's Baa3, and Fitch too has not really raised its rating. So this seems to be a uniform view. Am I correct, or sometimes there is a divergence between rating agencies?
Generally, there is not much of a divergence. There have been some periods when the one agency has done a downgrade and the others have taken time, and similarly in the upgrade cycle.
Right.
But on a steady state basis, most all three generally move in the same.
So the question that I was asking earlier as well. So we are going at close to 8% economic GDP growth. So why is it that does not really help improve an investment grade? A very specific question.
As I told you, that there is a disproportionate weightage on the fiscal balance. So the growth numbers or inflation numbers doesn't move the needle significantly. Okay.
Devendra, what's your sense? I mean, are investments likely to get further affected? Are they going to be neutral? Do they not care? I mean, what does the past tell us about the way things could pan out in the near future?
So I don't think so that ratings drive investments from a FDI or from an equity perspective. What could drive the investments? Probably the debt investments could be an issue if there is a downgrade. But I'm confident that the overall attractiveness of India, the flows won't stop or won't get disrupted. It might get disrupted due to reasons other than India. That means Donald Trump coming in and all this external events, Brexit.
Yeah,
and,
we've been
you know,
talking about that.
Yeah. So that won't take
Right.
place.
So
But
that's
otherwise,
a
I
question.
don't
Let me
think
put
so.
that quickly to you too. So you had, of course, the Donald Trump factor on one side, which is in some ways giving nervousness to markets. But also in India, you've had the announcement of a GST rate structure, which some people don't like, but it suggests that the policy movement is happening.
Yeah, I think what is more important is the momentum in the policy making. That's very important one. And as far as GST is concerned, it is very important that the infrastructure that is required for the GST to be in place. You have a lot of 20 plus states, working in a different rates and all. So that logistics part from a back end is very important for the smooth implementation of GST and the subsequent impact on the growth. So that infrastructure backbone has to be built up, including the technology part of it.
Right. So Sujan, you said that there is disproportionate weightage on the part of rating agencies on the fiscal situation. But if you were to look at some of the other potentially counterbalancing forces, including a GST rate strike or a rate movement that we've seen, the announcement of the day, how would you stack up?
See,
the positives
again,
and the negatives?
if you look at the impact of GST on fiscal situation, at least in the immediate future, it's more likely to be revenue neutral to slightly revenue negative.
Okay.
So if anything, it has a negative to neutral connotation for the fiscal deficit. Having said that, of course, this is a big reform. And I look at GST not so much from the government revenue perspective. I look at it from two perspectives. One, India becomes a common market, which India was never. And second, a corollary to that, the cost of compliance of the corporate sector goes down very, very significantly because of that. And the irritants in terms of stopping so many times if you are in a moving pan-India basis. I think this ease of doing business is far more effective, but it will take at least 2 to 3 years to pan out. So I think from that perspective, on a longer term perspective, it's extremely positive for India. Shorter term, maybe not so much.
Okay, right. So here's the other point that S&P made. They say that downward pressure on ratings could re-emerge, right? If growth disappoints, perhaps as a result of stalling reforms, if contrary to our expectations, the new monetary council is not effective in achieving its targets, or if the external liquidity position of the nation deteriorates more than we currently expect. So how do you read that?
So I think external liquidity situation is the risk which we had in 2013 in June when the QE tapering and when Dr. Rajan took over as the governor. It has substantially improved from there. You have a 360-370 billion worth of US dollars, and the more importantly is that the government has not borrowed in US dollars. It is this differentiates India from many of the rollover risk and the liquidity crisis. The total, if you look at the public debt, 92% of the public debt is domestic, and even that 8% which is external is completely multilateral and from IMFs of the world. So the rollover risk is very limited from an external perspective. Your gold, your oil values have come down. That has negated some of the negatives of a higher current account deficit. So I don't see much of external liquidity risk.
Right. So let me sort of bring out one quick statement here. So S&P also said that in the medium term we expect improved fiscal performance primarily from revenue side improvements brought about by the coming introduction of the GST, which we've talked about, and administrative efforts to expand the tax base. So obviously it's balancing out. It's acknowledging the fact that GST is moving forward, and that perhaps in some ways was a prelude to the announcement that we saw. Now, but all of this is clearly not enough. So what needs to be done is the question.
See, the point is that if you are talking from the narrow perspective of credit rating, obviously you have to improve your fiscal balance. And while there has been some amount of improvement, though not on the FRBM target, on the center side, in fact, there has been some slippage on the state side. Now, you would expect that with the GST coming into force and with the compensation mechanism for the next 5 years, the state's fiscal situation should improve. So I think that's the silver lining. I don't think there is anything government can do in a jiffy in terms of reducing the fiscal deficit, because you have to kickstart the investment cycle, particularly infrastructure investment, and public investment has a big role there. So I don't think government can really.
So if you were to draw out one thing that is the pending task, if so, we could say that it's really to kickstart investment in a big way, or it's, the attempts are being made, but clearly that's where maybe the gap lies, and filling of which will get the whole thing going.
Yeah.
Okay, Devendra, last word.
So I think GST is a big reform, as he rightly said. And also one point which I little differ from what the world thinks is that we might be surprised that the GST might result in lower inflation, whereas the global experience is that inflation goes up when the GST is implemented and comes down. I think if 50% of the CPI is not a part of GST, then we might have a steady to lower inflation that will reinforce the monetary policy. And also on the fiscal side, I think, Govind, I personally believe that counter-cyclical fiscal policy is so important here. If you have to boost the growth, you have to boost, and if you want to tolerate a bit of fiscal deficit, I think it should be it.
Right. So let's hope the Mandarins and Mint Street are listening to you. Thank you both for joining me. Well, we've run out of time. That's all we have time for on Policy Watch this week. We'll be back next week, same time. Thanks for watching.